Public banks never have to turn a profit a day in their life, ever. They don't have a profit requirement. The shareholders are the government. In private banks, you're always at risk that people are going to start selling off your shares and the value of the corporation or the business is going to collapse. That doesn't happen with public banks. Their business model, again, they don't need to maximize profitability. They do need to be sustainable, right? So they do need to earn enough returns on their loans and their whatever they do, their business model to be institutionally sustainable. But that doesn't mean profit maximization at all. For example, the KfW, Germany, considered one of the top run banks in the world, public or private, its return on assets is like 0.02 or something, which simply means that it generates very little return for the German government, but it is understood as a hugely successful bank because it really is able to respond to its policy mandate. This is a structural difference. There's no economic pressure for them to maximize profits. There are cases, of course, in certain countries and instances, like Turkey, for example, they have really big national public banks, and their government has put a mandate on them to be profit maximizing. That's a political decision, but it's not an economic requirement. Private banks, it's an economic requirement that they maximize returns. Otherwise, their shareholders will start abandoning them and the business will collapse. That does not apply to public banks. They have no structural or economic imperative to maximize profits. They're meant to be policy maximizers so they can generate enough returns to make their bank sustainable, but they don't need to maximize returns at all.